Before we dive in, it is critical to understand that this video is for informational and educational purposes only. I am not a licensed financial advisor or insurance agent, and this presentation is not a substitute for professional advice. The world of insurance is complex and varies significantly by state and individual circumstances. You should always consult with a qualified and licensed professional to determine the best coverage for your specific needs. Imagine this for a second. You're driving home from work. Maybe you're a little tired, you're thinking about dinner. You glance down to change the song on your phone, and in that split second, bam, you rear-end the car in front of you. It's not a huge crash. No one's hurt, thank God. But their bumper is dented, your hood is crumpled. You exchange information, you call your insurance company, and you think, okay, I'm covered. That's what I pay for. A few days later, you get a call. The agent tells you, great news, we're covering all the damages for the other driver's car. That'll be taken care of. You breathe a sigh of relief and then you ask, okay, so what about my car? When can I take it to the shop? And that's when you hear the 5 words that make your stomach drop. Your policy doesn't cover that. The repair bill for your car? $4,700. And it's coming directly out of your pocket. This exact scenario happens to thousands of Americans every single day. They pay their insurance bill on time, every month, believing they're protected. But they've fallen into a trap that's built on confusion, fine print, and 2 little words: liability and full coverage. The vast majority of drivers don't truly understand the massive difference between them, and that lack of knowledge is a ticking financial time bomb. But that's going to end for you right now. By the time this video is over, you are going to understand auto insurance better than 95% of the drivers on the road. You will know with absolute certainty which coverage is right for your car, your budget, and your life. We are going to cut through all the confusing jargon and give you the power to make a smart decision that could save you thousands or even tens of thousands of dollars. We're going to turn confusion into confidence. So let's start with the absolute foundation of all auto insurance in the United States: liability coverage. The word liability is just a legal term for responsibility. When you are found to be at fault in an accident, you are legally responsible, or liable, for the damage you caused. And that's all this insurance covers: the other person. It covers their car, their medical bills, their problems. It does absolutely nothing for you or your vehicle. Think of it like this. In nearly every state, the law requires you to have liability insurance just to be on the road. It's the absolute bare minimum, the legal price of admission to drive. It makes sure that if you mess up and crash into someone, you have a way to pay for their damages so they aren't left with the bill. It's insurance for everyone else on the road from you. Liability insurance is broken down into 2 simple parts. The first is bodily injury liability. This covers the medical expenses of the people in the other car if you cause an accident that injures them. We're talking hospital bills, ambulance rides, physical therapy, and even lost wages if they can't work because of the injury. It can also cover things like pain and suffering. Let's be crystal clear. Bodily injury liability does not cover your medical bills. It does not cover the medical bills of your passengers. It is only for the people in the other vehicle that you hit. The second part is property damage liability. This one is more straightforward. It pays to repair or replace whatever property you damaged with your car. Most of the time, this is the other person's vehicle. But it could also be a mailbox you knocked over, a fence you crashed through, or the side of a building you scraped. Again, let me say it so there is zero confusion. Property damage liability does not pay for the damage to your own car. If you have liability-only coverage and you cause an accident, you are 100% responsible for fixing your own vehicle. Let's put this into a real-world example. Let's say you have a basic liability policy, and you accidentally run a red light, T-boning a brand new SUV. The driver of the SUV breaks their arm, and their vehicle is severely damaged. Here's how your liability insurance would kick in. Your bodily injury coverage would pay for that driver's ambulance ride, their emergency room visit, their x-rays, and the cast for their broken arm. Your property damage coverage would pay the $20,000 bill to get their SUV repaired. The other driver is made whole. The system worked. But what about you? Your car is totaled. It's a twisted wreck. And because you only had liability coverage, your insurance company gives you exactly $0 for it. You just watched your car get towed to a junkyard, and you still have to figure out how to buy a new one all on your own. That is the brutal reality and the immense risk of carrying only liability insurance. Now, you've probably seen your insurance policy written out with a series of numbers, like 50/100/25. This looks like confusing code, but it's actually simple, and it's critically important you understand it. These three numbers represent your coverage limits in thousands of dollars. The first number is the bodily injury liability limit per person. Using our 50/100/25 example, your policy would pay a maximum of $50,000 for any single person's injuries in an accident you cause. The second number is the bodily injury liability limit per accident. This is the total maximum your policy will pay for injuries for the entire accident, no matter how many people are hurt. In this case, it's $100,000. So if you injured 3 people, your insurance would pay up to $100,000 total, but no more than $50,000 for any one of them. The third number is your property damage liability limit per accident. Here it's $25,000. This is the absolute maximum your policy will pay for all property damage in a single accident. So let's ask the scary question. Is that enough? Let's go back to our red light accident. The SUV you hit cost $20,000 to repair. Your $25,000 property damage limit covers it. You're fine. But what if instead of an SUV, you hit a brand new Tesla Model S? The repair bill for that isn't $20,000. It's $60,000. Your insurance pays its maximum limit of $25,000, and then it's done. It washes its hands of the situation. So where does the other $35,000 come from? Comes from you. The other driver's insurance company will sue you for it. They can go after your savings account, your investments, and in some states, even garnish your future wages until that debt is paid. Suddenly, a simple mistake behind the wheel has financially crippled you for years, all because your liability limits were too low. People choose the state minimums because they're cheap, but they are gambling with their entire financial future every time they get in the car. So who on earth should have liability-only insurance? It's really for a very specific type of person. First, you need to be driving an older, paid-off car that has very little value. A 10-year-old car with 150,000 miles on it might only be worth $2,000 or $3,000. If the extra cost to get full coverage is, say, $1,000 a year, you'd be paying a huge chunk of the car's value every single year just to insure it. It just doesn't make financial sense. If you wrecked it, you wouldn't be losing much. Second, and this is non-negotiable, you need to have a very healthy emergency fund. You need to be able to go out tomorrow and buy another $2,000 or $3,000 car with cash without it derailing your finances. If you can't afford to replace your car out of pocket, you can't afford to have liability-only insurance. It's that simple. You're essentially self-insuring your own vehicle, and you need the cash to back that up. So, if liability only covers the other guy, and it leaves you completely exposed, how do you protect yourself? How do you make sure that if your car is stolen or a tree falls on it, or you get into an accident that's your fault, you're not the one left holding a massive bill? That's where we get into the world of full coverage. But here's the first secret the insurance industry doesn't really want you to know. Full coverage isn't a real type of insurance. You can't call your agent and say, "Give me one full coverage." It's a marketing slogan. It's a nickname for a policy that combines liability insurance with 2 other critical types of coverage. And these 2 coverages are what protect your car, your investment, and your peace of mind. These 2 coverages are called collision and comprehensive. Think of them as the dynamic duo of car protection. While liability insurance builds a financial wall to protect other people from you, collision and comprehensive build a fortress to protect your own vehicle from the world. They are the heart of what people call full coverage. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or, if necessary, replace your car if it's damaged in a collision. This could be a collision with another car, or a collision with an object like a telephone pole, a guardrail, or a fire hydrant. It even covers you if your car flips over. To really understand its power, let's imagine a scenario. Meet Alex. Alex just bought a beautiful 3-year-old SUV. It's reliable, safe for the family, and Alex is proud of it. But Alex still owes about $17,000 on the car loan. One winter morning, the roads are slick. Alex is driving carefully, but hits an unseen patch of black ice. The SUV spins and slams backwards into a concrete retaining wall. The back end is completely crumpled. Thankfully, Alex is okay, but the car is a mess. The repair estimate comes back: $9,000. Now let's play this out 2 ways. First, imagine Alex only has the state minimum liability insurance. In this situation, because Alex was the only one involved, liability coverage does absolutely nothing. It's designed to pay for damage Alex causes to others. It does not pay a single penny for Alex's own car. So Alex is now in a nightmare scenario. Alex has a car with $9,000 in damage and still owes $17,000 to the bank. The bank doesn't care about the accident. They want their monthly payment every single month. Alex is now faced with a horrible choice. Drain a savings account to fix the car, take out another loan for the repairs, or try to drive a damaged vehicle, all while continuing to make payments on a car that's worth thousands less than what is owed. It's a financial trap. Now let's rewind. Let's say Alex had the foresight to get collision coverage. The accident still happens. The car is still damaged, but the aftermath is completely different. Alex calls the insurance company and files a claim. The insurance adjuster confirms the $9,000 repair cost. Alex has a $500 deductible on the collision coverage. A deductible is simply your share of the cost that you agree to pay before the insurance kicks in. So, Alex pays the body shop the first $500. The insurance company then pays the remaining $8,500 directly to the shop. The car gets repaired looking as good as new. The financial catastrophe has been completely avoided. The $17,000 loan is still on a car that's actually worth it. That $500 deductible is the cost of peace of mind. Collision coverage also saves you in messy situations. Let's say you're an offender bender in a parking lot, and the other driver swears it was your fault. Without collision, you have to wait for the insurance companies to investigate, fight it out, and assign blame. This can take weeks, even months. All the while, your car sits there damaged. With collision coverage, you don't have to wait. You can file a claim with your own company. They pay for your repairs minus your deductible and get you back on the road. Then they go to battle with the other driver's insurance company to get that money back. That process is called subrogation, but all you need to know is that it happens behind the scenes while you're already driving your fixed car. So that's collision. It covers damage from collisions. But what about all the other chaos the world can throw at your car? What about theft? Vandalism? A deer jumping out on the highway? That's where the second half of our dynamic duo comes in. Comprehensive coverage. Many in the industry actually call it other than collision coverage, which is a perfect description. It covers a huge range of incidents that can damage your car that don't involve a typical collision. Think of it as the life happens insurance. Your car gets stolen from your driveway? Comprehensive covers it. A hailstorm makes your brand new hood look like a golf ball? Comprehensive. A massive tree branch snaps off in a windstorm and crushes your roof? Comprehensive. Someone keys your door in a fit of rage? Vandalism is covered by comprehensive. A fire, a flood, an earthquake, all of these are covered by comprehensive. And here is one of the most misunderstood and important parts of this coverage. Hitting an animal. Let's say you're driving down a country road at dusk, and a deer leaps out in front of you. You slam on the brakes, but it's too late. The impact causes thousands of dollars in damage to the front of your car. Your first thought might be, well, I collided with a deer, so this must be a collision claim. But it's not. Hitting an animal is almost universally considered a comprehensive claim. Why does this matter so much? Two huge reasons. First, insurance companies see hitting a deer as an unavoidable accident, an act of nature, not a sign of bad driving. A collision claim, especially one where you're at fault like hitting a pole, is more likely to raise your insurance rates. A comprehensive claim? Much less so. Second, people often choose a lower deductible for their comprehensive coverage than for their collision coverage. You might have a $1,000 deductible for collision, but only a $250 deductible for comprehensive, making it much cheaper to fix the damage from that deer. So, when you hear that term full coverage, what it really means is a policy that bundles three things together: liability insurance, which is your shield to protect others, and then collision and comprehensive, which is your suit of armor to protect your own car. So, who actually needs this suit of armor? There are two main groups of people. First, and this is non-negotiable, are the people with a loan or a lease on their vehicle. If you are making payments to a bank or a finance company, they will require you to have both collision and comprehensive coverage. Why? Because until you make that final payment, the car is their asset. It's their collateral. They have a financial stake in that vehicle, and they need to make sure their investment is protected. If you were to total the car without that coverage, you'd stop paying, and they'd be left with nothing. The insurance policy guarantees that if the car is destroyed, the lender gets paid back what they're owed. The second group is anyone who cannot afford to replace their car out of pocket without it causing a major financial hardship. If you own your 10-year-old car outright, the choice is yours. And the decision comes down to a simple, honest question. If I walked outside tomorrow and my car was gone, stolen, or totaled in a hit and run, could I comfortably go out and buy another car with cash? If your car is a $20,000 vehicle you rely on every single day, and you don't have 20 grand just sitting around, then paying for full coverage is a critical financial safety net. But if your car is a $2,000 beater that you just use for weekend errands, paying an extra $40 or $50 a month for collision and comprehensive might not be worth it. The cost of the insurance could quickly add up to more than the car is even worth. In that case, you might choose to drop those coverages and essentially self-insure, accepting the risk yourself. So you have your liability, your collision, and your comprehensive. You're fully covered, right? You're protected from other people, and your car is protected from the world. Well, not exactly. What happens if you're hit by a driver who has no insurance at all? Or if your medical bills from a serious accident are way higher than the other person's tiny liability limits? That's where two more little-known but life-saving coverages come into play. And in the next part, we're going to uncover exactly what they are, and why they might be the most important part of your entire policy. So let's talk about them. These two coverages are called uninsured motorist and underinsured motorist protection. And they sound a little boring, I know. But stick with me, because understanding them could be the difference between a bad day and a ruined life. Let's paint a picture. You're driving home from work, stopped at a red light, maybe singing along to the radio. Suddenly, bam, a massive jolt from behind. You're slammed forward into the car in front of you. Your neck snaps back, your head hits the steering wheel, and the world goes fuzzy for a second. After the initial shock, you get out. Your car is a crumpled mess front and back. The driver who hit you is incredibly apologetic. "I'm so sorry, I was looking at my phone, it's all my fault." It's a clear-cut case. He's 100% at fault. You exchange information, a police report is filed, and you're taken to the hospital to get checked out. You have a concussion, severe whiplash, and 2 herniated discs in your back. Your car is totaled. But hey, at least the other guy admitted fault, right? His insurance will cover everything. Your medical bills, the months of physical therapy you're going to need, the wages you'll lose from being unable to work, the value of your destroyed car. It's all on him. Then you get the call. It's from your insurance agent and their voice is grim. The other driver. He doesn't have insurance. Your heart sinks. That feeling of relief evaporates and is replaced by pure, cold dread. Who is going to pay for this? The at-fault driver is a college kid working a minimum wage job. Suing him would be like trying to squeeze blood from a stone. You'll spend thousands on a lawyer just to get a judgment that says he owes you $100,000, which he will never ever be able to pay. So who pays? You do. Every single penny. Your health insurance might cover some of the initial hospital visit, but what about the deductibles? The co-pays? The ongoing physical therapy? What about the lost income? And what about the sheer pain and suffering this has caused you? And your car? Your car is just gone. You're left with a mountain of debt, a broken body, and a worthless pile of scrap metal. This is not a scare tactic. This is a daily reality for thousands of Americans. Because here's the terrifying statistic. On average, 1 in every 8 drivers on the road in the United States has no insurance. 1 in 8. In some states like Florida, Mississippi, and New Mexico, that number is closer to 1 in 4. Think about that. On your commute today, you likely shared the road with dozens, if not hundreds, of drivers who are rolling the dice completely uninsured. And that is where uninsured motorist coverage, or UM, becomes your financial superhero. If you have uninsured motorist coverage, when that uninsured driver hits you, your own insurance company steps in and acts as if they were the at-fault driver's insurance. They pay for your damages. It's broken into 2 parts. Uninsured motorist bodily injury, or UMBI, covers your medical expenses, your lost wages, and yes, even your pain and suffering. The second part is uninsured motorist property damage, or UMPD, which pays to repair or replace your car. Essentially, you are buying an insurance policy to protect yourself from the 13% of drivers who are illegally and irresponsibly on the road. You're insuring yourself against their mistake. Now let's look at the second, even sneakier scenario. Let's go back to that same accident. You get hit. The other driver is at fault. But this time he proudly hands you his insurance card. He's a responsible citizen. He has insurance. Phew, you dodged a bullet. But what kind of insurance does he have? He has the absolute bare minimum required by law. Let's say your state requires just $25,000 in bodily injury liability. Meanwhile, your initial hospital bill alone is $40,000. Your lost wages will be another $15,000. The future physical therapy is estimated at $20,000. Your total damages are approaching $75,000 or more. His insurance company will write you a check for $25,000. And that's it. That's all they are legally obligated to pay. Their client's policy is now maxed out. So where does the remaining $50,000 come from? Again, it comes from you. You're on the hook for the massive gap between your actual costs and the other driver's tiny, inadequate policy limit. You did everything right and they were 100% wrong, but you are the one facing financial ruin. This is where the second hero, underinsured motorist coverage, or UIM, swoops in to save the day. Underinsured motorist coverage does exactly what it sounds like. It protects you when the at-fault driver has insurance, but not enough insurance to cover your damages. In our example, after the other driver's insurance pays their $25,000 limit, your UIM coverage would kick in to cover the rest, up to the limits you selected on your own policy. That $50,000 gap? It's now covered. Your medical bills are paid. Your lost income is reimbursed. You can focus on healing instead of bankruptcy. This is the safety net for the safety net. Because let's be honest, the person buying the absolute cheapest state minimum insurance policy is often just one step above the person with no insurance at all. They're trying to do the right thing, but the protection they offer you is practically non-existent in a serious accident. So here is the single most important piece of advice you will get about this. Your uninsured and underinsured motorist coverage limits should be as high as your own bodily injury liability limits. Read that again. You should protect yourself and your family with the exact same level of coverage that you provide for a stranger. Think about it. Why on earth would you buy a policy that says, if I injure someone else, I'll provide them with $250,000 of coverage, but if someone else injures me, I'm only willing to give myself $25,000 of protection? It makes zero sense. You are paying to protect strangers more than you're willing to pay to protect yourself. You are betting that every single one of the millions of drivers on the road is more responsible than you are. That's a bad bet. A lot of people think, well, I have good health insurance, so I don't need high UM/UIM limits. That is a dangerous, costly mistake. Your health insurance does nothing for lost wages. It does nothing to compensate you for permanent scarring, long-term disability, or the simple debilitating pain and suffering that comes from a major accident. And it certainly won't buy you a new car. UM and UIM cover all of that. They are designed to make you whole again in a way that health insurance never can. These coverages aren't just add-ons. They are the core of your own personal defense strategy on the road. You can't control if the person texting in the lane next to you has insurance. You can't control if the person who runs a red light has a cheap state minimum policy. The only thing you can control is your own policy. You can control your own safety net. We've now covered how to protect yourself financially from other drivers, both the ones who break the law and the ones who just barely follow it. But what about everything else? What about the things that are truly no one's fault? A deer that leaps out of the darkness, a freak hailstorm that turns your car into a golf ball, a shopping cart that rolls into your door, or even that one time you misjudge a parking spot and back into a pole. That's where the final two pieces of the full coverage puzzle come into play, and they cover nearly everything else you can imagine. And understanding how they work is the key to never paying for a new car out of your own pocket ever again. Those two pieces are called collision and comprehensive coverage. And when you bundle them with your liability policy, that's what people in the real world, not the insurance world, call full coverage. It's not an official term, but it's the term we all use. It's the difference between protecting everyone else and finally protecting yourself. Let's start with collision. The name says it all. This coverage pays to repair or replace your car if it's damaged in a collision with another object. Think about that. Another object. Most people think this just means another car, and it does. If you misjudge a turn and rear-end someone at a stoplight, your property damage liability pays to fix their car. Your collision coverage pays to fix your car. Without it, you're on your own. You'd be standing on the side of the road, watching the tow truck haul away your crumpled vehicle, knowing that every single dollar for the repair, or for a new car entirely, is coming straight out of your bank account. But it's not just about hitting other cars. Remember, it's any object. Let's say you're driving home late one night. It's raining, the roads are slick. You take a corner a little too fast, your tires lose their grip, and you slide directly into a guardrail. Your liability insurance does nothing here. You didn't damage anyone else's property, but the entire front end of your car is destroyed. Collision coverage is what saves you. Or imagine you're trying to back out of a tight spot in a crowded parking garage, and you scrape your door all the way down a concrete pillar. It's an ugly $1,000 mistake. Collision has your back. You hit a pothole from hell that shatters your axle? That's a collision. You swerve to avoid a squirrel and hit a tree? Collision. You flip your car in an accident? That's a collision. In every one of these scenarios, the damage was caused by your car making impact with something else. And in every case, you were the one at fault. This is the single most important thing to understand about collision insurance. It protects you from your own mistakes. It's the I messed up coverage for your own vehicle. Now, before you think this is a magic credit card that fixes everything for free, there's a crucial catch. It's called your deductible. The deductible is the amount of money you have to pay out of pocket for a repair before your insurance company pays a single dime. It's your share of the cost. Deductibles typically range from $250 to $1,000, or even more. Let's say you have a $500 deductible. You get into that accident and the repair shop quotes you $6,000 to fix your car. You pay the first $500 directly to the body shop. Then your insurance company steps in and pays the remaining $5,500. If the damage was only $400, less than your deductible, you wouldn't even file a claim. You just pay it yourself. This is how the system works. And you get to choose your deductible. Here's the trade-off, and it's a big one. A lower deductible means you'll pay less out of pocket if you have an accident, but you'll pay a higher premium every month. A higher deductible means you'll pay a lower monthly premium, but you better have that higher amount, say $1,000, saved up in an emergency fund, because you'll be on the hook for it if something happens. Choosing your deductible is a personal bet on your own driving. So, collision covers you when you hit things. But what about all the other horrible things that can happen to a car that have nothing to do with a crash? What if you walk out to your car in the morning, and a tree branch has fallen and crushed your roof during a storm? What if a deer jumps out of the woods and you can't avoid it? What if a thief smashes your window and steals your stereo? Or worse, steals the entire car? None of these are collisions. You didn't hit anything. In fact, you weren't even driving for most of them. This is where the second piece of the puzzle, comprehensive coverage, comes in. And its name is a little misleading. It's not comprehensive because it covers everything. It's comprehensive because it covers almost everything else. All the weird, unpredictable, non-collision events. I like to call it the acts of God and acts of idiots coverage. Let's break it down. Acts of God. This is weather and nature. A hailstorm that turns your car's hood into a golf ball. A flood that swamps your engine. A lightning strike that starts a fire. A rock slide on a mountain road. And critically, hitting an animal. This is the one that confuses everyone. Hitting a deer is not a collision claim. It's a comprehensive claim. The logic is that you couldn't control the deer running into the road. It's considered an unpredictable act of nature. Then you have the acts of idiots, or just crime and random chance. Vandalism, like someone keying your car. Theft of the whole car or just parts of it, like your catalytic converter. A baseball flying out of a park and shattering your windshield. A rock kicked up by a truck on the freeway that cracks your glass. All of these bizarre, frustrating, and expensive events are what comprehensive is for. And just like collision, comprehensive coverage has a deductible. It works the exact same way. If a tree branch causes $3,000 in damage and you have a $500 comprehensive deductible, you pay $500, and the insurance company pays the other $2,500. Often, you can choose different deductibles for collision and comprehensive. You might feel you're a safe driver and unlikely to cause a crash, so you opt for a high $1,000 collision deductible. But you live in an area known for hail and car break-ins, so you choose a lower $250 comprehensive deductible. You can customize it to your risks. Now let's put it all together. This is where you see the true life-saving power of having so-called full coverage. We need to talk about the worst-case scenario. Your car is declared a total loss. This happens when the cost to repair your car after an accident is more than the car is actually worth. An insurance adjuster will look at the damage and say, the repairs are $10,000, but the car itself is only worth $8,000. It's totaled. If you only have liability insurance, this is the end of the story. Your car is a wreck. The insurance company gives you nothing for it. Zero. You are now without a car. And if you had a car loan, you still have to pay it. You are now making monthly payments to a bank for a pile of scrap metal sitting in a junkyard. It's a financial nightmare that has ruined people. But if you have collision or comprehensive, everything changes. If your car is totaled in an accident that was your fault, your collision coverage kicks in. The insurance company won't pay to fix the car. Instead, they will determine your car's actual cash value, or ACV. That's the market value of your car the second before the crash happened. They'll take that amount, say $8,000, subtract your $500 deductible, and they will write you a check for $7,500. If your car was stolen and never recovered, comprehensive coverage does the same thing. They'll cut you a check for the car's value, minus your deductible. If it was destroyed in a flood, same thing. That check is your lifeline. It's the money you use to pay off your old car loan, and if there's any left, to put a down payment on your next car. You are made whole again. You are not ruined. You are not stranded. This is the ultimate safety net. This is the reason people pay for full coverage. It's not just about fixing dents and scratches. It's about protecting you from a catastrophic financial loss that could set you back for years. So now we see the whole picture. Liability protects everyone else from you. Collision and comprehensive protect you and your wallet from the world. But this raises a huge question. This coverage sounds amazing, but it's also not cheap. It can add hundreds, even thousands of dollars a year to your premium. So when is it worth it? And when are you just throwing money away? The answer depends almost entirely on the car you drive. And it's not as simple as you think. Let's start with the single most important concept you need to understand. Actual cash value, or ACV. This is the number that dictates everything. When your car is totaled in an accident or stolen, the insurance company does not care what you paid for it. They don't care what a brand new one costs. They don't care about your sentimental attachment to it. They care about one thing and one thing only. What was your specific car with its exact year, make, model, mileage, and condition worth the second before it was destroyed? That number is the actual cash value. It's a brutal, unsentimental calculation of depreciation. And it is the absolute maximum amount of money your insurance company will ever pay you for that car, period. So the first step in deciding whether to keep full coverage is to face reality and find out your car's ACV. Don't guess. Don't think about what you paid for it. Go to a site like Kelley Blue Book, Edmunds, or NADA Guides. Punch in your car's information. Be honest about the condition. Is it excellent? Or does it have a few dings and a stained interior? Be brutally honest. Now look for the value listed as private party, or sometimes trade-in value. Do not look at the retail price. The retail price is what a dealer would sell it for after cleaning it up and adding their profit margin. You won't get that. The private party value is a much closer estimate of your car's ACV. Let's say you do this. You have a 2016 Toyota Camry with 90,000 miles. You find out its ACV is about $10,000. Okay, that's step one. Step two is to look at your policy and find your deductible for collision and comprehensive coverage. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single dime. Let's say your deductible is $1,000. Now we get to the critical calculation. Step 3. Subtract your deductible from your car's actual cash value. In our Camry example, that's $10,000 in ACV, minus your $1,000 deductible. The result is $9,000. This number, $9,000, is the absolute maximum benefit you can ever receive from your full coverage policy for this car. If the car is totaled, they will write you a check for $10,000, but only after you've effectively paid your $1,000 deductible, leaving you with $9,000 to find a new car. This is where most people stop. They think, okay, paying for insurance to protect a $9,000 asset seems reasonable, but they're missing the most important part of the equation. Step 4. Find out how much you are actually paying for full coverage. This isn't your total premium. Your total premium includes liability, which you have to have anyway. You need to call your agent or look at your policy breakdown and find the specific cost for just the collision and comprehensive portions. Let's say for our Camry driver, it's an extra $800 per year. So here's the real question. Are you willing to pay $800 this year for the chance to protect a maximum payout of $9,000? For most people, the answer here is yes. That feels like a reasonable trade. But what happens when the car gets older? Let's fast forward 5 years. Same Camry, but now it has 160,000 miles on it. It's seen better days. You look up the ACV again. It's plummeted. It's now worth only $4,000. Your deductible is still $1,000. And because of inflation and risk pools, your full coverage cost hasn't dropped that much. Still say $650 a year. Let's run the numbers again. $4,000 in ACV minus your $1,000 deductible equals a maximum possible payout of $3,000. $3,000. And you are paying $650 a year for it. You're paying $650 to protect a $3,000 asset. Now does it seem worth it? You would have to pay that premium for less than 5 years before you've paid the insurance company more than they could ever possibly give you back. This is the trap millions of people fall into. They add full coverage when the car is new, and then they just forget about it, letting the auto payment go through year after year, long after the math has stopped making sense. So how do you know where to draw the line? I'm going to give you a powerful rule of thumb that many financial experts use. It's called the 10% rule. Here it is. If the annual cost of your comprehensive and collision coverage is more than 10% of the potential payout from your insurance, it's time to seriously consider dropping it. Let's apply it. In our first Camry example, the potential payout was $9,000, $10K ACV, $1K deductible. 10% of that is $900. The annual cost for the coverage was $800. Since $800 is less than $900, the 10% rule says you should keep the coverage. It's providing good value. Now look at the older Camry. The potential payout was $3,000, $4K ACV, $1K deductible. 10% of that is just $300. But the annual cost of the coverage was $650. That cost is more than double the 10% threshold. It's a terrible value. According to this rule, you should drop full coverage immediately. Instead of giving that $650 to the insurance company, you should take that money and put it into a dedicated savings account, an emergency fund for car repairs, or a down payment on your next vehicle. This is called self-insuring. You are taking on the risk yourself, but you're also keeping the cash. After a few years of saving that premium, you'll have enough to cover most major repairs or even replace the car entirely, without ever having to file a claim that could raise your rates. Now, this rule is a guideline, not a gospel. There's a human element here. The second question you have to ask is, could you handle the financial shock of losing your car tomorrow? If your car worth $4,000 got totaled, would you be able to come up with $4,000 to buy another one without it completely derailing your life? Do you have savings? Could you take the bus for a while? If the answer is yes, then self-insuring is a smart financial move. But if losing that car means you can't get to work, can't feed your family, and you have $0 in the bank, then paying that $650 a year might be worth the peace of mind. It's a safety net. You have to be honest about your own financial stability. There is, however, one situation where none of this math matters, and it is critically important. If you have a loan on your car, or if you are leasing it, you do not have a choice. The bank or leasing company that technically owns your vehicle will require you, in the terms of your contract, to maintain full comprehensive and collision coverage for the entire life of the loan or lease. Why? Because the car isn't just your asset, it's their asset. It's the collateral for your loan. They need to make sure that if you total it, their investment is protected. They will get their money back from the insurance company. If you try to drop full coverage while you still have a loan, you will be in breach of your contract. The lender can and often will buy a policy for you, called force-placed insurance, at an outrageously expensive rate and add the cost to your loan payment. So rule number 1 is, if you don't own the title to your car free and clear, you must have full coverage. End of story. But once that car is paid off, the decision is yours. And it should be an active decision you reevaluate every single year when your policy comes up for renewal. Don't just let it slide. Pull out your policy, look up your car's current ACV, and run the numbers using the 10% rule. It takes 10 minutes and it could save you hundreds, even thousands of dollars over the life of the car. You could be throwing money into a bonfire without even realizing it. So you've run the numbers, you've decided full coverage is right for you. Or maybe you've decided to drop it. The decision is made. But we're not done optimizing. Because the cost of that coverage, whether it's just liability or full-blown protection, can vary wildly. The key is in the details. Specifically, in that number we keep talking about, the deductible. Choosing the right deductible is one of the easiest and fastest ways to slash your insurance bill without sacrificing crucial protection. But choosing the wrong one can be a catastrophic mistake that makes your insurance almost worthless when you actually need it. So how do you find that sweet spot? It's a balancing act. A high-stakes game of risk and reward where the prize is your financial security. The secret isn't in finding some obscure, hidden insurance company. It's in understanding the two most powerful levers on your policy: your deductible and your coverage limits. Master these and you master your insurance bill. Let's start with the deductible. Think of it as your entry fee to a claim. It's the amount of money you have to pay out of your own pocket before your insurance company steps in and pays a single dollar. If you have a $500 deductible and you cause $3,000 worth of damage to your car, you pay the first $500, and your insurer covers the remaining $2,500. Simple, right? But here's where millions of people make a colossal mistake. They're terrified of that deductible, so they choose the lowest one possible, maybe $250 or even $0. Feels safe, feels responsible, but what they don't realize is that they are paying an enormous hidden price for that feeling of safety. A lower deductible means a significantly higher premium, month after month, year after year. You're essentially prepaying in small installments for an accident you hope never happens. Let's run the numbers. Let's say dropping your deductible from $1,000 down to $500 costs you an extra $40 per month. That's $480 a year, every single year. If you go 3 years without an accident, you've paid an extra $1,440 in premiums just to avoid a potential $500 out-of-pocket cost. You've paid almost 3 times the amount you were trying to save. It's a losing bet, and the insurance company is the house, and the house always wins. The financially savvy move, the one that puts the odds back in your favor, is to raise your deductible. Go for $1,000, maybe even $1,500 if you can swing it. Yes, it feels scary, but this is the critical part. You are not just taking on that risk blindly. You are making a calculated decision. You take the money you save on your premium, that $40, $50, $60 a month, and you put it directly into a dedicated high-yield savings account, an insurance deductible fund. In our example, saving $40 a month means you'll have the extra $500 to cover the difference in your deductible in just over a year. From that point on, every dollar you save is pure profit. It's money in your pocket, not the insurance company's. You are self-insuring for the small stuff, the fender benders, the scrape bumpers, which you can afford to handle, so you can pay less for the insurance company to cover the big stuff, the catastrophic, financially ruinous accidents, which you can't. This strategy requires one non-negotiable rule. You must have your deductible amount saved and easily accessible. If you don't have $1,000 in the bank, do not get a $1,000 deductible. But if you do, choosing a low deductible is like paying a bodyguard to protect you from a pesky fly, while leaving your front door wide open for a burglar. And that brings us to the burglar, the real life-altering threat: your coverage limits. This is the other lever, and frankly, it's the one that can utterly destroy your financial future if you get it wrong. While your deductible affects what you pay for damage to your car, your liability limits determine how much your insurance company will pay for damage you cause to other people and their property. And this is where the term state minimum becomes one of the most dangerous phrases in personal finance. Every state has a minimum amount of liability insurance you're legally required to carry. It's often expressed as a series of 3 numbers, like 25/50/25. This would mean your policy covers up to $25,000 for bodily injury to one person, $50,000 total for bodily injury to everyone in the accident, and $25,000 for property damage. To the average person, those numbers might sound like a lot. They are not. They are a financial time bomb. Many of these state minimums were set decades ago. They haven't kept pace with the insane inflation in medical costs and vehicle prices. $25,000 for property damage? The average price of a new car in America is over $48,000. What happens if you skid on some ice and you total a brand new Ford F-150? Or a Lexus? Or a Tesla? Your insurance pays the first $25,000. You are personally on the hook for the rest. That's $23,000 or more you have to come up with. But that's not even the scary part. The real nightmare is the bodily injury. You cause an accident, and the other driver needs surgery and months of physical therapy. Their medical bills hit $80,000. Your state minimum policy with its $25,000 limit pays out that amount, and then it wishes you the best of luck. The other driver's lawyers will then turn to you for the remaining $55,000. And they will get it. They will come after your savings account. They will come after your investments. They can put a lien on your house. They can get a court order to garnish your future wages, taking a chunk of your paycheck every single week for years, or even decades. Your entire financial life derailed. Your ability to save for retirement, to pay for your kids' college, to build a future, all of it gone because you tried to save maybe $10 or $20 a month on your car insurance. Skimping on liability coverage is the definition of being penny-wise and pound-foolish. It's like buying the cheapest possible smoke detector for a house full of priceless art. So what's the sweet spot? For the vast majority of drivers, a good safe starting point is 100/300/100. That's $100,000 for bodily injury per person, $300,000 per accident, and $100,000 for property damage. This level of coverage protects you from all but the most catastrophic of accidents and provides a strong defensive wall around your assets. And the best part? The jump in premium from state minimum to this responsible level of coverage is often shockingly small. You might be talking about the price of a few cups of coffee a month to increase your financial protection by hundreds of thousands of dollars. Now let's put it all together. This is the master strategy. This is how you play the game to win. You call your insurance agent and you do two things. First, you raise your collision and comprehensive deductible to at least $1,000, assuming you have that money in your emergency fund. This will immediately lower your premium. Then, you take those exact savings, and you plow them directly into increasing your liability coverage to at least 100/300/100. You see the genius of this? You're performing financial arbitrage on your own insurance policy. You are accepting a small, known and manageable risk, a higher deductible that you've already saved for, in order to eliminate a massive, unknown and life-destroying risk, a lawsuit that could bankrupt you. You pay less for the small stuff so you can have ironclad protection from the big stuff. This single move can save you money on your premium, while simultaneously making your insurance infinitely more valuable. You're no longer just legal. You're protected. But what about the things that liability and collision don't cover? What about a hit and run, where the other driver just vanishes? Or what happens when you get slammed by one of the millions of drivers out there with no insurance at all? In those cases, your fancy 100/300/100 liability coverage does absolutely nothing for you. There are two tiny, often overlooked add-ons to your policy that cost pennies, but can save you from complete financial devastation in these exact scenarios. And in the next part, I'm going to reveal exactly what they are, and why your insurance agent might not even be telling you about them. The first, and I cannot stress this enough, the most criminally overlooked coverage on an auto insurance policy is called uninsured and underinsured motorist protection. Let's call it UM/UM. This isn't an upsell. This isn't a luxury. This is the shield that protects you and your family from financial ruin when the person who hits you breaks the law. Let me paint you a picture. You're driving home from work. You're a safe driver, you've got full coverage. You've done everything right. Suddenly, a speeding car runs a red light and T-bones you. The crash is violent. Your car is totaled. You wake up in a hospital with a shattered femur, facing months of surgery and physical therapy. You can't work. The driver who hit you, he was texting. And as you find out later, he has zero insurance. Absolutely nothing. So what happens now? Your collision coverage, part of your full coverage plan, will pay to replace your car, minus your deductible. Great. But what about you? What about the $500,000 in medical bills that are about to start piling up? What about the 6 months of lost income from your job? Who pays for that? The guy who hit you? He has no money and no insurance. You can sue him, sure. But you can't get blood from a stone. You'll win a piece of paper that says he owes you money he will never, ever have. This is where the nightmare begins for millions of Americans. They believe full coverage protects them. Doesn't. It protects your car. Protects you from being sued. It does not protect your body or your bank account from an uninsured driver, unless you have uninsured motorist coverage. This is the coverage that steps in and acts as the insurance the other driver should have had. It pays for your medical bills, pays for your lost wages, pays for your pain and suffering. It is, without a doubt, one of a handful of the most important financial products you will ever buy. And here's the terrifying part. Right now, as you are driving on the roads in the United States, 1 out of every 8 drivers around you has no insurance. 1 in 8. In states like Florida, it's closer to 1 in 4. You are surrounded by financial time bombs every single day, and most people have no idea. Then there's the second part, underinsured motorist. This is just as dangerous. Let's say the driver who hits you does have insurance, but they bought the cheapest plan legally allowed, the state minimum. In many states, that might be just $25,000 for bodily injury. Your shattered femur, the surgeries, the rehab, your medical bills are $300,000. The other driver's insurance writes you a check for their maximum of 25 grand. Who pays the remaining 275,000? You do. Unless you have underinsured motorist coverage, which pays the difference all the way up to your policy limit. So why isn't your agent screaming this from the rooftops? Why don't they make it the very first thing they talk about? Comes down to a simple cold reality of sales: price. Insurance is a brutally competitive market. When you shop for a quote online, you're looking for the lowest number. A policy with high limits of uninsured and underinsured motorist coverage costs more than one with low limits. So to win your business, an agent or a website will often quote you the bare minimum required by law, or they'll set your UM/UIM limits to match your low liability limits, just to present you with a more attractive, lower premium. They're not necessarily being malicious, they're just playing the game. They assume you'll ask for more if you want it, but how can you ask for something you don't even know you desperately need? The second piece of the puzzle is called medical payments coverage, or MedPay. In some states, it's a more robust version called personal injury protection, or PIP. Think of this as your immediate first aid fund. It's a smaller amount of coverage, typically ranging from $1,000 to $10,000, that pays for medical expenses for you and your passengers immediately after an accident, regardless of who is at fault. Why is this so important? Because fault takes time to determine. Let's say you have a minor accident. You have passengers in your car. An ambulance comes, you all go to the ER to get checked out. That's thousands of dollars right there. Instead of waiting weeks or months for the insurance companies to battle it out, MedPay pays those bills right now. No deductible, no questions asked. It can cover your health insurance deductible, co-pays, dental work if your tooth gets chipped on the steering wheel. It protects your friends in the car from having to sue you or go through their own health insurance for an accident that happened in your vehicle. It's goodwill in a bottle. And the cost to add $5,000 or $10,000 of this coverage is, quite literally, the price of a single cup of coffee per month. It is the cheapest, easiest peace of mind you can buy. Next up is rental reimbursement. This one sounds simple, but its importance has skyrocketed in the last few years. This coverage pays for a rental car while your car is in the shop being repaired after a covered accident. A few years ago, you might have thought, I can get by for a few days. But we are not living in that world anymore. With supply chain issues and body shop backlogs, repairs that used to take 3 days now take 3 weeks. Or 3 months. I'm not exaggerating. Now do the math. The average cost of a rental car is $50 a day. If your car is in the shop for 30 days, that is $1,500 out of your pocket just to be able to get to work and live your life. For 60 days, it's $3,000. Rental reimbursement coverage costs on average about $5 a month. It is a no-brainer. But here's the secret trick. Agents will often sell you the lowest tier, like $30 a day. In today's market, $30 a day might not even cover the taxes and fees on a rental, let alone the car itself. You need to make sure you have at least $50 or $60 a day in coverage. The difference in your premium is pennies, but the difference in your real-world protection is massive. Finally, let's talk about the twin shields that protect you from the single biggest enemy of a car owner: depreciation. They are gap insurance and new car replacement. When you buy a brand new car, it loses about 20% of its value in the first year. Let's say you buy a $40,000 SUV. You put a little money down and finance the rest. 1 year later, you still owe the bank $36,000. But the car's actual cash value is only $32,000. You are upside down by $4,000. Now imagine that car gets totaled. Your insurance company looks at the market value and writes you a check for $32,000. That's all they owe you. But you still have to pay the bank $36,000. So you take that whole check, give it to the bank, and then you have to reach into your savings and pull out another $4,000 to pay off the loan. On a car that is now a heap of twisted metal, you are left with no car and you're $4,000 poorer. It is a devastating financial blow. Gap insurance prevents this. It pays for the gap between what your car is worth and what you still owe on your loan or lease. It pays off the bank so you can walk away clean with no debt on a car that no longer exists. New car replacement is the next level up. It's Gap's bigger, stronger brother. If your new car is totaled in the first year or two, it doesn't just pay off your loan. It gives you the money to buy a brand new, current model year version of the car you just lost. It completely erases that first year depreciation hit and makes you truly whole again. So why doesn't every agent push this? Often they assume you bought it at the dealership, where it's sold at a hugely inflated price and rolled into your loan with interest. The secret is that buying gap or new car replacement directly from your insurance company is almost always dramatically cheaper. These coverages, uninsured motorist, MedPay rental and gap, are not frills. They are the essential pieces that turn a basic full coverage policy into a real suit of armor. Without them, you are leaving gaping holes in your financial defenses, exposed to the most common and catastrophic risks on the road. But here's the million-dollar question. What are the right dollar amounts? How much uninsured motorist coverage is enough? Is $50,000 enough? $100,000? In the next part, we're going to break down the exact numbers you should have on your policy to be truly bulletproof. And I'll reveal a simple formula you can use to figure out your perfect coverage levels without ever talking to an agent. Alright, let's talk numbers. Not the boring, confusing numbers an agent throws at you, but the numbers that act as a financial fortress around your life. The numbers that stand between you and having your wages garnished for the next 20 years. First, we need to understand why the numbers your state requires you to have are, frankly, a joke. They are a trap, designed to give you a false sense of security. Let's imagine a driver, we'll call him David. David is a good guy, a responsible driver. He's never been in an accident. He sees that his state only requires him to have 25/50/25 coverage. That's $25,000 for bodily injury to one person, $50,000 total for bodily injury to everyone in the accident, and $25,000 for property damage. He thinks, great, I'm following the law, I'm covered. He chooses the cheapest plan to save a few bucks a month. One rainy Tuesday afternoon, David is driving home. He glances down at his phone for just a second. A notification. But that's all it takes. The car in front of him slams on its brakes. David reacts, but it's too late. He hydroplanes and slams into the back of a brand new Honda Odyssey minivan. The impact shoves the minivan into the car in front of it, a 3-year-old Lexus. Now let's do the math on David's very bad day. The minivan has a family of 4 inside. The mom, who was driving, suffers severe whiplash and a herniated disc in her back, requiring surgery. The dad in the passenger seat breaks his wrist. The 2 kids in the back have concussions and minor injuries. The Lexus driver is shaken but okay, but her car has significant rear-end damage. Let's look at the medical bills first. The mom's surgery and physical therapy alone cost $85,000. The dad's broken wrist, ER visit, and follow-ups cost $15,000. The 2 kids' hospital evaluations and follow-ups add another $10,000. That's a total of $110,000 in medical bills for just one vehicle. Remember David's policy? His bodily injury limit is $50,000 total for the entire accident. His insurance company writes a check for $50,000 and says, "That's all we're on the hook for. Good luck." David is now personally responsible for the remaining $60,000 in medical bills. But it gets so much worse. The mom is a graphic designer who can't work for 6 months because of her back surgery. That's $40,000 in lost wages. The family's lawyer also sues for pain and suffering, easily another $100,000. So now, on top of the $60,000 in leftover medical bills, David is facing another $140,000 lawsuit. He is now personally on the hook for $200,000. And we haven't even talked about the cars yet. The brand new Honda Odyssey is declared a total loss. Its value? $45,000. The Lexus has $12,000 in damages. The total property damage is $57,000. What was David's property damage limit? $25,000. His insurance pays that out, and now David has to personally come up with the other $32,000 to fix or replace the cars he hit. His grand total, his personal responsibility after his coverage ran out? $232,000. David doesn't have $232,000. The court issues a judgment against him. They garnish his wages, taking a chunk of his paycheck every single week. They put a lien on his house. His dreams of saving for his kids' college, of retiring someday? Gone. Wiped out in a single second of distraction, all because he was carrying state minimum insurance. This isn't a scare tactic. This happens every single day in America. So what is the answer? What are the bulletproof numbers? Let's stop thinking about the bare minimum and start thinking about a gold standard level of coverage. For the vast majority of people, this is what you should aim for: $250/500/100. Let's break that down. The first number, $250, means your policy will pay up to $250,000 for bodily injury to a single person. Think about the mom in our story. Her $85,000 in medical bills, her lost wages, her pain and suffering, a $250,000 limit would have likely covered all of it. This isn't just about a broken arm. This is for the kind of serious life-altering injuries that lead to massive lawsuits. The second number, 500, is your total limit for bodily injury for the entire accident. This means your policy will pay up to $500,000 for all the people you injure combined. In David's case, the total medical bills and lawsuits were well over $200,000. A $50,000 limit was a catastrophe. A $500,000 limit would have meant his insurance company handled the entire negotiation and payment, and David wouldn't have paid a dime out of his own pocket. This is your multi-car, multi-person protection. The third number, 100, is for property damage. Your policy will pay up to $100,000 to repair or replace the vehicles or property you damage. Why so high? The average price of a new car in the US is now over $48,000. If you hit one new pickup truck or SUV, you could easily blow past a $25,000 or $50,000 limit. What if you hit a Tesla Model S, which can cost over $90,000? What if you skid on ice and cause a chain reaction involving 3 or 4 cars? What if you swerve off the road and hit a storefront? $100,000 is the new realistic minimum for the world we live in. Now you might be thinking, that sounds expensive. And how do I know if 250/500/100 is right for me? This brings us to the simple formula I promised. I call it the net worth shield formula. It's incredibly simple, and it's what financial advisors use. Step 1. Figure out your approximate net worth. This isn't as complicated as it sounds. Just add up your assets, the value of your home if you own it, your savings accounts, your 401k or other retirement funds, any major investments. Then subtract your liabilities, what you owe on your mortgage, your car loans, student loans, credit card debt. The number you're left with is your net worth. It's what you own free and clear. Step 2. Here is the formula. Your bodily injury liability coverage should always be higher than your net worth. Let me repeat that. Your liability coverage should be higher than your net worth. Why? Because it's a signal to the other party's lawyers. When you cause an accident and someone gets hurt, their attorney immediately investigates 2 things: how much insurance coverage you have, and what your personal assets are. If you have a $50,000 insurance policy but you have $150,000 in home equity and savings, you are a prime target for a lawsuit. The lawyer knows your insurance will pay out quickly, and then they can come after you for the rest. They will sue you for your house, your savings, your future. But if you have a $500,000 insurance policy and a $150,000 net worth, the game changes completely. The lawyer sees that massive insurance policy and knows the easiest, fastest way to get the biggest payout for their client is to settle with your insurance company. The insurance company has a legal duty to defend you, and they have a financial incentive to settle the claim within your policy limits to avoid a bigger payout later. Your high limit becomes a shield. It tells the world, my insurance company is handling this. They have deep pockets. Don't bother coming after my personal assets. By having coverage that exceeds your net worth, you make yourself a less attractive target for a devastating lawsuit. Your insurance company takes the hit, not your life savings. This is the single most important concept in personal finance that almost no one understands. Your liability insurance isn't just for the other person. It's the first and most important line of defense for everything you've worked for. So, the gold standard of 250/500/100 is a fantastic starting point for most people. But what if you've worked hard and your net worth is more than $500,000? What if you own a business or have a large investment portfolio? Does that mean you're out of luck? No. That's when you graduate to a secret weapon that the wealthy use to protect their assets, a tool that is shockingly affordable. It's called a personal umbrella policy. And it's not just for the super rich. It's one of the most powerful and overlooked financial tools available to almost anyone with something to lose. Think of it this way. Your auto insurance and your homeowner's insurance are like a really good raincoat. They protect you from the everyday storms of life. A fender bender, a leaky pipe, a guest who slips on your steps. They have limits, but for 99% of situations they're enough. But what happens when the hurricane hits? What happens when you face that 1 in a million life-altering lawsuit? A catastrophic car accident that causes permanent disability. A momentary lapse in judgment that leads to a multi-million-dollar legal battle. Your raincoat is useless in a Category 5 hurricane. You'll be soaked, financially speaking, in seconds. An umbrella policy is your personal hurricane shelter. It's a massive secondary layer of liability protection that sits on top of your existing policies. Here's how it works, and it's beautifully simple. Let's say you have the 250/500/100 liability limits on your auto insurance that we talked about. The maximum your policy will pay for injuries to one person is $250,000, and the max for the entire accident is $500,000. Now, let's go back to our story with Dr. Evans. The light turns red, she glances down for a split second, and the next thing she knows, she's caused a devastating multi-car pileup. The other driver, a young architect with a promising career, suffers injuries that will require a lifetime of care. The lawsuit arrives. They aren't suing for $500,000. They're suing for $2 million. Suddenly, Dr. Evans feels the floor drop out from under her. Her auto insurance will pay its limit, that first $500,000. But what about the other $1.5 million? That's her responsibility. That's her house. That's her retirement fund. Her kids' college savings. Her future earnings garnished for decades. Everything she has ever worked for is on the line, about to be wiped out because of one single terrible mistake. It's a nightmare scenario, but then her insurance agent calls. He reminds her of a conversation they had 3 years prior. He'd looked at her assets, her home equity, her investments, her income, and said, "Doctor, you are a target. We need to get you an umbrella." She barely remembered agreeing to it. It was an extra charge on her bill that she just paid without thinking. It cost her about $40 a month. $40. And here's the magic. That $40 a month policy was for a $2 million umbrella. So when the lawsuit hits, her auto insurance steps up and pays out its maximum of $500,000. Then, like a guardian angel, the umbrella policy descends and covers the remaining $1.5 million. Every single penny. The lawsuit is settled. The victim gets the care they need. And Dr. Evans' life, her home, her savings, they are all completely intact. That small, forgotten monthly payment just saved her entire financial future. The return on that investment is almost infinite. Now you might be thinking, okay, but that's a crazy car accident. What are the odds? But the true power of an umbrella policy is that it's not just for your car. It extends its protection over almost every aspect of your life. It's a blanket liability shield. Let's run through some rapid-fire scenarios. Your teenager throws a party while you're out of town. Someone drinks too much, drives home, and causes a wreck. You, the parent and homeowner, get sued. Your homeowner's policy might cover the first $300,000 or $500,000. But if the damages are in the millions, the umbrella policy kicks in. Your friendly dog gets scared and bites a delivery person. The injury is severe. Lawsuit. Your homeowner's policy pays its limit. The umbrella covers the rest. You're coaching your kid's little league team. A pop fly hits a player in the eye, causing permanent damage. The parents sue you for negligence. Your homeowner's policy might not even cover this, but your umbrella policy often will. You write a scathing online review of a local contractor. You accuse them of fraud. They sue you for libel and for damaging their business, seeking hundreds of thousands of dollars in damages. Guess what covers that? The umbrella policy. You're on vacation in Europe, you rent a boat, and you accidentally crash into a dock, injuring several people. The umbrella policy extends its coverage worldwide. It covers your cars, your home, your boat, your rental properties, your kids, and even your words. It is the single most comprehensive liability protection you can buy. And now for the part that sounds like a lie but isn't. The cost. We established that the wealthy use this tool. So it must be expensive, right? Wrong. This is the biggest secret. For the average person, a $1 million umbrella policy typically costs between $150 and $300 a year. Let me repeat that. For about the price of a single fancy dinner out, you can get $1 million in extra protection for an entire year. Bumping that up to $2 million might only cost another $100. It is, without a doubt, the single best bargain in the entire insurance industry. It's like buying a steel vault for the price of a piggy bank. So who needs one? The old advice was that you need an umbrella policy if your net worth is greater than your liability limits. I'm telling you that advice is outdated and dangerous. In today's world, you need an umbrella policy if you have anything to lose. You don't need to be a millionaire. Do you own a home? You need an umbrella. Do you have a 401k or an IRA? You need an umbrella. Do you have kids, a dog, or a swimming pool? You need an umbrella. Because here's what a plaintiff's attorney does. They don't just look at what you have now. They look at what you will have. They can go after your assets, but they can also get a judgment that garnishes your future wages. For years, decades even. So even if you don't have a high net worth today, an umbrella policy is protecting your most valuable asset, your future earning potential. It protects the life you haven't even built yet. Now there is a catch. Insurance companies won't just sell you an umbrella policy in a vacuum. They need to see that you're responsible with your base layers of coverage. To get that $1 million umbrella, the insurer will require you to have high limits on your underlying policies first. They'll typically mandate that you carry at least a $250/500/100 limit on your auto insurance and at least $300,000 in liability on your homeowner's insurance. They want to know that your raincoat is solid before they'll sell you the hurricane shelter. You have to handle the small storms yourself before they'll step in for the catastrophe. So we've covered it all. State minimum liability, which is just enough to be legal but leaves you dangerously exposed. We've covered full coverage, which protects your car but does nothing extra for your assets. We've talked about maxing out your liability limits to build a strong foundation. And now you know about the ultimate protection, the umbrella policy that shields everything you own and everything you will ever earn. The pieces are all on the table. You know what they are and why they matter. But the final, most important question remains. How do you put it all together for your specific life? How do you balance the cost against the coverage to build the perfect, custom-fit suit of financial armor, without overpaying or leaving a critical gap in your defense? Let's build that suit of armor piece by piece. The process isn't about finding a secret formula. It's about asking yourself a series of brutally honest questions. Your answers will illuminate the perfect path for you. First, the most straightforward question: what is your car actually worth? Not what you paid for it. Not what you feel it's worth. What is its actual cash value or ACV today? This is the amount an insurance company would cut you a check for if it were totaled. You can get a very good estimate in about 5 minutes using free online tools like Kelley Blue Book or Edmunds. Just plug in your car's year, make, model, mileage, and condition. Now look at that number. Here's a powerful rule of thumb many financial advisors use. If the annual cost of your comprehensive and collision coverage, the full coverage part, is more than 10% of your car's value, it's time to seriously question if it's worth it. Think about it. If your car is worth $4,000, and you're paying $800 a year for full coverage, you're spending 20% of the car's entire value every single year, just for the option to have it repaired or replaced. After a few years, you will have paid more in premiums than the car is even worth. At that point, you're no longer insuring a valuable asset. You're just paying for a very expensive peace of mind policy. The second question is even simpler. It's a yes or no. Do you have a loan or a lease on your vehicle? If the answer is yes, the decision is made for you. You need full coverage. Period. It's not your choice. It's a requirement from your lender. And it makes perfect sense. Until you pay off that loan, the bank or finance company is a part owner of your car. They have a financial interest to protect, and they are not going to risk you totaling their asset and walking away leaving them with the loss. They require you to carry full coverage as a condition of the loan to ensure their investment is protected. So, if you're making car payments, you can stop this part of the analysis right here. You're in the full coverage club until that title is in your hand, free and clear. Now, for those of you who own your car outright, we arrive at the most important question of all. This is where you have to look past the car and look into your own bank account. The question is this: if you walked outside tomorrow and found your car was gone, stolen, or totaled by a falling tree, could you, without causing a major crisis in your life, afford to repair or replace it? I want you to really think about what that means. It's not just about having the money. It's about what using that money would do to your financial stability. Do you have a $5,000, $10,000, or $15,000 emergency fund set aside? If you do, that's fantastic. But would using a huge chunk of it to buy a new car mean you can no longer cover 6 months of living expenses if you lose your job? Would it derail your down payment savings for a house? Would you have to cash out investments you were counting on for retirement? If the answer is yes, writing that check would be painful, but I could do it without jeopardizing my financial security, then you are a prime candidate for considering liability-only insurance. You have the financial strength to self-insure against the loss of your vehicle. You are choosing to accept that risk yourself in exchange for saving hundreds, maybe thousands of dollars per year in premiums. But if the answer is no, I absolutely could not afford to replace my car without going into debt or wiping out my entire savings, then the decision is clear. You need full coverage. This is the entire point of insurance. You are paying a company a small, predictable fee, your premium, to protect you from a large, unpredictable, and potentially devastating financial loss. You are transferring the risk of replacing your car from your shoulders to theirs. For you, full coverage isn't a luxury. It's a critical component of your financial safety net. It ensures that one bad day, one moment of bad luck, doesn't send your entire life spiraling. Finally, there's the human element, your personal tolerance for risk. Are you the kind of person who sleeps better at night knowing you are covered for nearly every possibility? Does the thought of a surprise $5,000 expense give you anxiety? If so, the peace of mind that full coverage provides might be worth the cost, even on an older car. There's no shame in that. It's a valid personal choice. Or are you someone who is comfortable with calculated risks? Do you see that premium money is better off invested or saved? Confident in your ability to handle a potential loss yourself? That's also a perfectly valid choice. But here's the expert-level strategy, the way to truly customize your suit of armor so it fits perfectly. It's not always a black or white choice between bare-bones liability and maxed-out full coverage. There is a smart middle ground. First, let's talk about the one area you should never compromise: your liability limits. Whether you choose liability only or full coverage, getting state minimum liability is one of the biggest financial mistakes a person can make. State minimums of, say, $25,000 for bodily injury were set decades ago. In today's world of six-figure medical bills and lawsuits, that amount is a joke. It's like trying to stop a tidal wave with a picket fence. If you cause a serious accident and the damages exceed your tiny liability limit, the other party's lawyers won't just stop. They will come after you personally. They can go after your savings, your investments, your house, and even garnish your future wages for years to come. Saving $10 or $15 a month by choosing minimum liability is not worth risking a lifetime of financial ruin. Always opt for higher limits. A good starting point is 100/300/100. That's $100,000 for bodily injury per person, $300,000 per accident, and $100,000 for property damage. The cost to increase your limits this high is usually surprisingly small, and it is the single best insurance investment you can make. Second, you can strategically use your deductible. Your deductible is the amount you pay out of pocket on a comprehensive or collision claim before the insurance company pays the rest. A common deductible is $500, but if you raise it to $1,000 or even $1,500, your premium for full coverage will drop, often significantly. This is a brilliant strategy if you have a healthy emergency fund. You're telling the insurance company, I can handle the small stuff, the fender benders up to $1,000. I just need you to protect me from the big catastrophic loss. You get the protection of full coverage at a much lower price, blending self-insurance with traditional insurance. So let's bring it all home. Here is your final checklist. You should absolutely have full coverage if you have a loan or a lease, your car is less than 5 years old or worth more than about $7,000, or if you could not easily afford to replace it with cash from your emergency fund tomorrow. You can confidently consider liability-only insurance if you own your car outright, its value is low enough that the premiums are a significant percentage of its worth, and you have a robust emergency fund that could absorb the entire cost of replacing it without derailing your life. And the universal rule for everyone, no matter what you drive: max out your liability limits. It is the cheapest, most effective way to build a firewall between a car accident and the rest of your financial life. Your car insurance isn't just another bill you have to pay. It's a dynamic, strategic tool. It's your shield. And as your life changes, as your car gets older, your income grows, and your savings increase, the design of that shield needs to change with you. Don't just set your policy and forget it. Review it every single year. Ask these questions again. The goal isn't just to be insured. It's to be smartly insured. And now you have the blueprint to do exactly that.